One of the most important factors in options pricing is delta, which is the directional risk of the trade. Delta is so important, in fact, that one of the other primary option Greeks, gamma, is used to measure the rate of change in delta in respect to the underlying asset's price. Gamma helps us determine how fast the delta of our option positions will move around on us. In other words, gamma, what it really tells us is the P&L of our options positions. Are they going to see bigger swings or smaller swings? So we continue our journey through the primary option Greeks. Today we're going to learn the option Greek gamma. So again, what are the Greeks? If this is your first video, if you haven't checked out my videos on delta or theta yet, what the option Greeks are, they're important metrics that help you monitor your current option positions and manage your portfolio. The Greeks, they're typically not used in trade selection process. That's not really what they're designed for. You don't put on a trade based on the Greeks. What the Greeks do after you have a trade put on, the Greeks help you monitor whether that position is working for you or working against you. For trade selection, you should be much more focused on things like liquidity of the underlying asset, probability of profit, implied volatility rank, risk versus reward, return on capital, those kinds of metrics. The four primary Greeks are delta, theta, gamma, and vega. I've already done videos on both delta and theta. Of course, I'm covering gamma today. If you want me to cover vega in a future video, please let me know. Post a comment down below if you want vega in a future video. So what is gamma? Well, first let's talk about delta. So remember on my video about delta, delta is the estimate of how much an option's value will change if the underlying asset, the underlying stock that you sold the option on, if it moves up and down $1 in price, all other factors being equal. So what gamma is, it's the rate of change in the delta of an option with respect to changes in the underlying price. So it's a measure of how much an option's delta changes in response to changes in the price of the underlying. Now, if none of that made sense to you, let's actually go to the trading platform that I'm using here, TASTYTRADE, and let's go to the Google options chain. So I'm going to go ahead, I'm going to choose a really close in expiration. So I'm going to do the 5-day expiration here, and I've got delta as a column here. I'm also going to add gamma as a column here. So let's imagine I buy a call. Let's imagine that I buy this at the money call right here. So this is the 56 delta call. Right now I would have to pay a debit of $2.17. So I'd have to pay a debit to buy a call. Of course, anytime you buy an option, you have to pay a debit. Anytime you sell an option, you receive a credit. So the value of this option is $2.17 when I purchase it. But what if Google goes up $1? What if Google goes up from 150.77 to 151.77? Well, the price of my option is also going to rise in value. How much is it going to rise in value? Well, if its delta is 56, then the option price should also rise 56 cents. So my 217 option is going to become 273, right? If it rises by 56 cents. So that is delta. Delta tells you how the price is going to increase or decrease based on the movement of the underlying stock. Now what gamma does, it tells you how delta is going to increase if the stock moves up or down by $1. So you can see that the gamma on this at the money call here is 9. So what this means is this option that I'm buying, this call that I'm buying for $2.17, if Google goes up $1, the delta is 56 currently, the delta will then move to being a delta of 64 because it's going to increase by 9 points, essentially 9 deltas. So that is what gamma is telling us. It's going to tell us how large a move that delta move is going to be if the underlying asset moves up or down by $1. And remember when we discussed delta, delta is kind of a quick way to gauge the win rate of a trade. For example, this 56 delta call here, this long call, I'm going to win on it 56% of the time. Well, if the gamma is 9, so if Google goes up $1 and the delta changes from 56 to 64, that means that's a big increase. That's 9 percentage points, essentially, if the delta changes from 56 to 64. So that is a drastic change on that option. That also is a drastic change in my win rate because it's a big difference between winning 56% of the time and winning 64% of the time. That's a huge change. So that's just a very quick look at delta and gamma on the options chain. If I go back to the slide here, when the underlying price changes, delta changes. Gamma measures the rate of change or the acceleration of delta with respect to changes in the underlying price. A good analogy here is delta is the speed of the car, right? And gamma is the acceleration. It's how fast it gets to that speed, right? So when you go to a car lot, you'll often hear prospective car buyers ask the salesman, how fast will it go from 0 to 100? Well, option traders, they want to know that as well. They want to know about the acceleration of delta. In this case, they want to know how quickly the delta of their option is going to change. If it's going to make really small changes, and then, that option price is not going to move around that drastically. Your P&L is not going to move around that much. But if you have a high gamma, then the delta of your option is going to change drastically, which means your P&L swings on that option are also going to change quite drastically. One way I like to think of gamma is gamma is almost like the next level of delta. So if I go back to the options chain here, what I'm talking about here on that same long call here is, right now my delta is 56. If Google moves from 150 to 151 in price, but what if it goes from 151 to 152? Well, I can kind of figure out what my next delta level will be on that next dollar movement, that second dollar movement, because gamma will tell me that my next delta will be not 56 but 64 on that next dollar movement. So you can kind of think of gamma as a way to give you the delta $2 away instead of just $1 away. I hope that makes sense. So long options have positive gamma, short options have negative gamma, but when you look at the options chain, gamma is always going to be positive on the options chain. So because they always assume you're going to buy an option rather than sell an option when you're looking at values on an options chain. So, you've got the gamma column here, all the values are positive on the call side. The gamma values here on the put side, all are positive values, right? They're assuming you're going to buy calls and buy puts. But if instead you sell an option, for example, if I sell that at the money call that I bought earlier, but instead I sell it, if the positional gamma is actually, instead of a positive 9 like the option chain displays, it's actually a negative 9. Now let's talk about gamma, time, and moneyness. So if your gamma is high, you should pay close attention to your position, or you should pay closer attention to your position, especially as you near expiration with positions that are really close to at the money. This is because gamma increases as expiration draws near, and gamma is always highest for options that are hovering around the at the money mark. The reason for this should be obvious. So when you think about it, if an option is either very far in the money or very far out of the money, the moneyness of that option is not likely to change, right? If you've got something really deep in the money and we're at expiration is drawing near, we only have a few days left, for example, the likelihood of that thing suddenly becoming out of the money becomes very low. So gamma will be low. Same thing with something that's very far out of the money. The likelihood that that thing's going to finish in the money, very low, right? But those options that are hovering around that at the money mark, there is a ton of uncertainty around those. We don't know where those are going to finish, right? Because, gamma on those at the money options are really what we're worried about. So when I went to the Google options chain, I purposely picked something that only had a few days left, this 5 DTE expiration, because gamma will be really high for an expiration cycle that's close to being at the end, right? And as I stated, gamma is always highest around the at the money mark. So these options, if I just click on some options here, all these options, you can see the gamma value 8, 9, 8, 7. These have really high gamma because these options are kind of close to that at the money mark, right? And any of these options, they have a chance of, reversing. Some of them are already out of the money. Some of them may become in the money, vice versa on the other side. But if I clear all of that out, the options that are really far in the money or out of the money, like if I go all the way out here to 83 deltas, right? Gamma is only 5 on that thing. If I go all the way out to 91 deltas, and this option here, gamma is only 3, where gamma is 9. At the money option. And the reason gamma is so low all the way out here is because this option really only has about a 9% chance of actually becoming in the money, right? So there's really not much chance of that option reversing its moneyness, and that is what you need to pay attention to. Really, gamma only is something you need to worry about if you're holding an option very late into an option cycle. If you just have a few days left in an option cycle, gamma is really going to start ramping up. And if those positions you hold, if some of those options are hovering around that at the money mark, gamma is going to be very high. So let's talk about gamma risk. This is the term you'll hear options traders talk about all the time. Gamma risk, what is that? Well, I've kind of already described it, talking about the risk of holding options late into a cycle, especially options that are near at the money, those huge P&L swings that you're going to see on those options. That's gamma risk. So if an option has a large gamma, a high gamma, its delta is going to approach 1.0 very quickly, meaning the option price is going to start moving close to a 1-to-1 movement with the underlying stock. That's why those P&L swings are so high, is because it's almost moving exactly like if you just owned 100 shares of stock. So your price swings are much higher than they typically would, say really far out in time, like 60 DTE, for example. And obviously such a high gamma presents a lot of risk, and we call that risk gamma risk. Essentially, gamma risk means that the price of an option becomes exponentially more volatile as it gets closer to expiration. So gamma risk will result in wild P&L swings. And as always, to smooth things out a little and make our trading life a little less crazy, the best way to avoid gamma risk is to follow the 45-21 DTE rule. What that means is put on your options positions at 45 days to expiration and be out of them at 21 days to expiration. Why? It's because, at 21 DTE, that's 3 weeks from expiration. That's well before you have to worry about crazy things like gamma risk and delta risk and all those huge P&L swings you'll see if you hold options late into the cycle. Just get out early. That way you don't have, all of that volatility. Now, the one exception to getting out of your options positions prior to expiration is if you're running the wheel strategy, say you sell a short put or even a covered call, and you're planning on accepting assignment on the position, even if it's a loser, then, go ahead, just hold to expiration. You don't have to worry about gamma risk at that point because you're not closing it for cash. You're not settling it for cash anyway. You want the shares either put to you or called away. So if you're planning on taking assignment, gamma risk really, it's not a factor. Now, should you monitor your gamma? Now, this might be a little controversial, but for me personally, while I think it's absolutely crucial that every options trader knows their delta and theta numbers, knowing your gamma is much less important. You really don't need to monitor gamma. As an options trader, all you need to know is that gamma exists, right? There's a formula for it, and that, gamma, there's such a thing as gamma risk, right? And all you need to know is don't hold options late into an option cycle. Don't hold at the money options, especially late into an option cycle. Other than that, do you need to know what those actual gamma numbers are? Absolutely not. There's no reason to be monitoring that stuff every day. If I go to my positions tab, see, I'm not even monitoring gamma, for example. So I'm monitoring my deltas, of course, because that's by far the most important Greek. I also have my theta numbers here. I even have my vega numbers, which we'll get to vega maybe on a future video. I don't even bother putting gamma on my positions tab because, again, it's not something that you necessarily really need to monitor. You need to know that gamma risk is a real thing, and you need to know to avoid gamma risk. And once you know that, you're good. So in my opinion, gamma is by far the least important Greek. Every option trader, you need to know how gamma works. You need to know the dangers of gamma risk, but knowing those actual gamma numbers is really not necessary at all. But if you wanted to monitor your gamma, you could. If you wanted to monitor your gamma, you may be wondering, hey, what is high gamma? What numbers should I be on the lookout for? I would say a value above 5 can be considered high gamma. And again, you're never going to really suffer from high gamma values, again, unless you're late into an option cycle with at the money options. And just to verify this, if I go back to the Google options chain, instead of doing the 5 DTE cycle, if I go all the way out to 55 DTE, which would be more likely where you first place a trade, what is the at the money call here? What is the gamma on it? It's only 2. Right? It's very low gamma. Why? It's because we have so much time left. Gamma won't ramp up until we get much later into the option cycle. And the really far in the money and out of the money options have basically no gamma at all on them. So again, gamma is something to know about. You should know it exists, but monitoring your actual gamma numbers is really not something that I do, and it's not something that most option traders do. So that was a brief overview of the option Greek gamma. Now I've covered delta, theta, and gamma on camera. If you guys want Vega on camera, let me know in the comments down below. And if you want to read a little bit more about the primary option Greeks, I cover the 4 primary option Greeks in my book, The Super Wheel Option Strategy, which is available on Amazon. You'll find a link to that book in the description down below. Peace, guys.